Every single item on this list is completely legal. Not a single one requires a scam artist, a stolen identity, or broken law. They're sold to you in broad daylight, at the mall, at the car dealership, at the gas station counter. And together they quietly drain more wealth from working Americans every year than almost any illegal scheme ever could. These are 10 financial products built, priced, and marketed specifically to keep you exactly where you are, and by the end of this video, you'll be able to spot every one of them coming. Number 1. Rent-to-own furniture and electronics. The pitch is simple. No credit check, low weekly payments, take it home today. What almost nobody calculates is the effective interest rate hiding inside those low payments. Independent studies put it between 100 and 300% APR, and the total you pay by the end of the contract often runs 2 to 3 times the item's actual retail price. A finance purchase on ordinary 18% credit card, paid off over that same 18 to 24-month time frame, would cost less than half, sometimes closer to a quarter, of what rent-to-own extracts from you for the identical couch. The furniture never changes. Only the math changes, and only in one direction. Number 2, extended warranties. Retailers push them hard at checkout because the math overwhelmingly favors the store, not you. Gross margins on extended warranties routinely run 40 to 80%. Multiples of the 15 to 20% margin on the product itself, and at the highest end retailers have reported profit rates north of 200% on the warranty alone. Meanwhile, the actual failure rate on most electronics during the warranty window sits around 5 to 8%. People behave as if it's closer to 13. That gap between perceived risk and real risk is the entire product. The warranty isn't insuring you against a likely event. It's ensuring the store's profit margin against an unlikely one. Number 3, deferred-interest store financing. The 0% for 12 months offer at furniture and electronic stores. Here's the mechanism almost nobody reads in the fine print. If you don't pay the full balance before the promotional window closes, even by $1, even by 1 day, the retailer doesn't just start charging interest going forward. It retroactively charges interest on the entire original balance, backdated all the way to day 1, often at 26% or higher. Someone who paid off 98% of a $2,000 sofa can still owe interest calculated on the full $2,000 for the full 12 months. The 0 isn't a discount. It's a trapdoor with a very specific expiration date, and the store is counting on you forgetting exactly when it closes. Number 4, payday loans. The advertised fee looks small, $15 per 100 borrowed for 2 weeks. Converted to an annual percentage rate, that's roughly 391%, and in states without a rate cap, it can top 600. A $500 loan becomes $575 in 2 weeks. Miss that window, roll it over, and the fees compound on top of fees rather than on top of the original balance shrinking. This isn't a lending product designed to be repaid once and closed out. Structurally, it's designed to be renewed. The entire revenue model depends on a meaningful share of borrowers rolling the loan forward multiple times before they ever pay it off. Number 5, buy here, pay here, subprime auto loans. These dealerships finance the car themselves, skip the traditional credit check, and charge for the privilege. A weighted average of roughly 25% APR versus about 15% at a traditional subprime lender for a comparable borrower. The real story is what happens after the sale. Loans from these dealers end up in active repossession at a rate over 16 times higher than loans from traditional auto lenders, and delinquency runs 2 to 3 times higher industry-wide. The business isn't really structured around selling one car to one owner. It's structured around selling and reselling the same handful of cars over and over to a rotating set of buyers who can't quite make the payments work. Number 6, Dealer add-on gap insurance. The exact same coverage that costs $50 to $150 a year from your regular auto insurer gets sold to the finance desk for $500 to $700, rolled directly into your loan, and quietly financed at your car's interest rate for the next 5 or 6 years. Dealers routinely mark up the underlying policy 50 to 100% and pocket the difference as pure commission. And in one of the largest FTC settlements against an auto dealer group, add-on products like this one were found carrying profit margins above 99%. Nothing about the coverage itself changes. Only where and how you buy it does. Number 7. Whole life insurance sold as an investment. As pure insurance for the right household, it can genuinely make sense. As an investment, the incentives get ugly fast. Agents earn commissions of 90 to over 100% of your entire first-year premium for selling you a whole life policy, compared with 30 to 70% for term. The cash value inside typically grows around 4 to 6% a year, while behind what that same money would likely earn in a simple low-cost index fund over the same stretch. Because a large chunk of your early premiums went straight into paying the person who sold it to you rather than into your own account. Number 8. Timeshares. The purchase price is real, usually financed, usually pitched hard during a 90-minute presentation with a free breakfast attached. The resale value, in a vast majority of cases, is not real at all. Most timeshares resell for 10 to 30% of what the original owner paid, meaning a 70 to 90% loss the moment you try to exit, and plenty are functionally worthless on the resale market, selling for literally nothing while the annual maintenance fees keep arriving regardless, every single year for as long as you own it. You're not buying an asset that can appreciate. You're buying a subscription with an enormous, non-refundable entry fee attached to the front of it. Number 9. Debt settlement companies. Marketed as the rescue plan for people already drowning in debt, they typically charge 15 to 25% of your enrolled balance, collected only once they've negotiated a settlement, which sounds reasonable right up until you see the completion rate. Roughly 45 to 50% of enrolled people actually finish the program. Everyone else pays months of fees while their unpaid accounts keep accruing interest in the background, and their credit report absorbs a settled for less than the full balance owed, mark that can sit there and depress their score for up to 7 years, regardless of whether the settlement ever actually closed. Number 10. Lottery tickets and scratch-offs. This one is state-endorsed, which is exactly what makes it worth including on a list like this one. For every dollar spent, roughly 53 cents comes back to players on average, a 47% structural loss, by design, built into the game before a single ticket is printed. Households earning under $10,000 a year spend an average of nearly $600 annually on tickets, and the heaviest playing 40 million households in the country account for roughly 80% of all lottery spending nationwide. It is functionally a voluntary tax collected almost entirely from the people who can least afford to be the ones paying it. None of these 10 products are illegal, and none of them are hidden. They're advertised on billboards, at checkout counters, in your mailbox, on the radio during your commute. What they share is a business model that only works if you don't do the math, and a design engineered to make doing that math as inconvenient and as easy to skip as possible. Knowing this list doesn't mean these products are always wrong for everyone in every situation. Some genuinely fit some households. It means you get to make that decision with the real numbers sitting in front of you, instead of the numbers the seller decided you should see. If this opened your eyes, subscribe. Every video, we decode how money actually works, because the people who understand the system are the ones it works for.